Hello, I'm Wade McWayne, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. So far in this pandemic year, one of the big ideas to capture investor imagination is Tesla, a colossus that joined the prestigious S&P 500 on December 21st. The stock ended last week at its highest level ever. Even more impressive is Tesla's market cap, which currently stands at a staggering $658 billion. Only 5 companies are larger than Tesla in the S&P index. In fact, right now, only 8 other companies are bigger than Tesla in the world. The story behind Tesla is well known, a highly innovative car manufacturer that is revolutionizing the automobile sector. Tesla was the first to popularize electric vehicles when most other auto companies were still making diesel and gas cars. It was the first car company to mass-produce car batteries in its 5 gigafactories. Highly automated, these plants extend Tesla's competitive edge as they lowered cost and increased production speed. Tesla was also the first to pioneer autonomous driving, the technology that will help drivers to navigate the road easier and safer. Tesla is also the first car company to create a network effect with renewable energy. By using Tesla's solar panels to recharge its cars, owners will be able to utilize clean energy, which is good for the environment. All these advancing components are coming together to start churning profits for the company. Just recently, the firm reported 5 quarters of profits, which made Tesla eligible to be included in the S&P 500 index, a fact that excited investors throughout the whole summer. The reason is simple. With $11 trillion of funds indexed or benchmarked against the S&P, there is a wall of money ready to snap up Tesla's stock once it joins the blue chip index. In fact, a group of opportunistic traders mopped up Tesla's shares just to sell these tracker funds. Last Friday, more than $140 billion of Tesla shares changed hands as the funds rebalanced their portfolios. Since bottoming out at $70 in March, Tesla stock is now up an eye-catching 893%. The 5-for-1 share split in August may have fueled even more speculative buying. Musk's wealth has matched the stupendous rise in Tesla's stock price. Over the weekend, Forbes.com estimated Musk to be worth over $150 billion, second only to Amazon's Bezos. The question for many Tesla shareholders now is this: at what point should we start leaving the party? All stock parties end at some point, and Tesla is no different. Even Musk himself tweeted earlier this year that Tesla's stock price is too high. But leaving the party, I don't mean selling the stock short. That's way too dangerous. Did you know that many short sellers have lost their shirts on Tesla this year? Some estimated they have lost more than $35 billion. During a bull market, stock prices often rise to astronomical values before falling back. Where and when this rally will end is anyone's guess. In many cases, rallies peak at around number levels like 1,000 or 5,000. For example, Amazon's rally this year paused at $3,500. Gold pulled back sharply once prices hit $2,000. Silver lost momentum at $30, and so on. For Tesla, the big level is obviously noted at $1,000, but watch for a loss of momentum as prices approach $700 or $800. All the institutional investors that needed to buy Tesla have bought. Some corrective price action may occur. The risk of consolidation is especially large for Tesla because its share price is significantly above trend indicators such as the 200-day moving average. Moreover, at $650 billion in market value, Tesla is almost hitting the ceiling. Its price-earnings ratio is estimated to be more than 600. Generally, the higher the ratio, the more optimistic investors are on the stock. North of 500 implies that investors are very optimistic on Tesla. In comparison, Apple, the world's largest stock worth more than $2 trillion, commands a price ratio of only 38. Yes, Tesla is a leader in the car-making sector, but is it worth more than all of the rest of the automobile stocks combined? Next year, traditional automakers will launch a fierce counterattack on Tesla's position with electric vehicles of their own. Competitors like Toyota, Volkswagen, Mercedes-Benz, and Nissan will all have a lineup of electric vehicles ready to launch. This will narrow Tesla's current commanding lead in the electric vehicle sector. If you're fortunate to own a few Tesla shares, locking in some profits on further strength would be prudent. But what should we invest in after selling Tesla? Right now, there's no better story than Tesla. Investing is about the future. Perhaps we should consider the less sought-after sectors because they are less expensive. Perhaps we should look to other ventures of Elon Musk, such as his foray into space, but that's another topic for the new year. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. Remember, make sure you do your own due diligence before making any investment decisions.